So liquidity often happens in the face of weakness. And so liquidity is not necessarily correlated with the economy. It often precedes it.
Okay.
Um, and so, for example, the some of the most liquid you get is, for example, in the early parts of 2020, we got some of
Hmm.
the biggest ever liquidity injections, but that was before the economy was still on its knees. Um, and so that's actually sometimes where you get a divergence between, say, a purely liquidity-driven asset and a more economy-driven asset.
In this insightful discussion, financial analyst Lyn Alden emphasizes the crucial role of liquidity in financial markets, asserting that liquidity trends often precede economic shifts. Alden highlights the divergence between assets influenced by liquidity and those tied to the economy, citing examples like US value stocks versus tech titans. Despite global economic softness, an uptick in global liquidity is observed, prompting authorities to inject liquidity into markets. Alden notes that while traditional indicators show economic weakness, unconventional assets like gold and Bitcoin thrive in liquidity-driven environments, detached from conventional economic performance. The conversation underscores the significance of understanding liquidity dynamics for navigating financial markets. With that, let's dive into the video to hear Lyn's full thesis.
So if you look at a lot of if you look at equities, for example, outside of like the best, seven performing US stocks, right? So all those big tech titans, many of them are expensive. But if you look at, say, US value stocks, more cyclical stocks, they've been kind of weak over the past year, in line with a kind of a somewhat weaker economy, kind of a, where we have below 50 purchasing managers index for manufacturing. We have very negative readings on the conference board leading indicators, right? So a lot of economic things are soft. And then, as you pointed out, China is very soft, Europe's very soft. Um, and so there is a lot of economic weakness throughout the world, but that's partially why there's been an uptick in global liquidity. That basically a number of authorities have found it necessary to add liquidity back into the market despite still having struggles with inflation. Um, and so that's one factor. And that's where you potentially get a divergence between, stocks that are more tied to the economy itself can still do kind of lackluster. Whereas, if this was a different era, we probably would see gold a lot higher right now. Because gold is, it's more of that liquidity driven, like a debasement type of protection. It's not necessarily tied to the economy. And then now we're seeing obviously Bitcoin in a lot of that role, which is that Bitcoin it doesn't have earnings, it doesn't have to worry about unemployment. It's mainly about, is there enough liquidity to flow into it, or are people kind of forced sellers
Hmm.
in a liquidity crisis? And as long as liquidity is decent, Bitcoin historically tends to be pretty decent, and it's divorced from the performance of the economy.
In this next segment, Lyn Alden provides a detailed analysis of the unexpected turns in the financial landscape. Alden attributes the surprising resilience to a larger fiscal response, particularly in the latter part of 2022. She highlights the Treasury's strategic actions to counter the Federal Reserve's tightening, injecting liquidity into the market. The discussion delves into the impact on interest rates, pointing out that the abundance of liquidity cushions the system, benefiting certain segments while posing challenges for others. Alden emphasizes the importance of adapting to evolving information, citing the need to respond promptly to unforeseen developments. Drawing parallels with the 1940s, she underscores the value of historical context while acknowledging the dynamic nature of current financial dynamics.
Well, so that's why it surprised me initially, and I had to kind of in real time take into that account the information that's happening and see what's happening with the models. The main answer I would say is that the fiscal was larger, and so if you look at the first three quarters of 2022, that's when you had the full force of the tightening. So the rates were going up, the balance sheet was going down, at the Federal Reserve, and the Treasury and the fiscal side was not really offsetting it at all. So it was just, assets across the board were down, everything was down, the economy was decelerating by almost all metrics, but starting in that kind of fourth quarter of the year. That's when you started to get the Treasury offsetting the Fed. So first they began dumping their Treasury general account cash back into the market, which is pro liquidity. and they continued doing that all the way up through May of this year, of last year, 2023. And then the second lever they pulled was to start issuing more short duration bonds than long duration bonds. And that allowed them to pull capital out of the reverse repo facility and push that back into the market. And so the Treasury's done two different types of actions that have more than offset the Fed's liquidity drain. And so that's been beneficial for both US markets and to some extent global markets because it took the edge off the dollar index. And as you know, there's a lot of global debt denominated in dollars.
Mm-hmm.
And so when the dollar strengthens relative to other currencies, a lot of those companies get squeezed. You don't want your income to be in the weak currency and your debts to be in the strong currency. But ever since that exact moment, that fourth quarter of last year, we saw the dollar index kind of come off its highs, which then gave the globe kind of some breathing room. So that was a big factor. And then two, the interest rates were interesting because that was surprising. I would say one is that there's just so much liquidity in the system, so much extra cash still in there, that it kind of gives a lot of buffer to get through it. And two, it's the fact that the kind of the middle class, upper middle class homeowners have a lot of that debt is fixed rate, mortgage debt kind of fixed rate. Investment grade corporations, again, a lot of that's low fixed rate. So very little of that has actually impacted these entities. Mostly it's felt in small businesses, which use shorter duration bank loans normally, non-investment grade corporations, so junk rated corporations that generally have shorter duration debt, people that rely on credit cards. So, working class and kind of lower working class, they're more impacted, unfortunately, by some of these policies. And then ironically, the federal government itself has pretty short duration debt, on average something like 6 years. But a lot of that's like front loaded in the first year or two, and then they have a long tail that goes out to 30 years. And so they're actual centers in that first few years. So they start exploding out interest expense. And what a lot of people don't realize is that interest expense, all these deficits on the federal side are someone else's surplus. So they could be flowing into offshore investors that own the treasury debt. They're flowing into onshore investors that have money markets, that have T-bill exposure. Any sort of mid-duration bond or lower is doing pretty well. There's been a re-increase in the wealth effect from equity prices and real estate prices kind of bouncing back on a nationwide average. And so that was kind of a big factor for how we were able to get through that. And again, the challenge was, if you asked a lot of people in early 2022, including me, can they raise to 5% and it not, kind of blow things up? We would have said, oh, probably not. But I think the key is that you respond to information early when it starts to happen. You say, okay, what is happening that I didn't necessarily predict, and what is the sequence of events playing out? And so it was important to be to kind of move with that as it happened. It's kind of, I keep pointing to the 1940s as the closest analog,
Right.
And that while that has been incredibly useful, it doesn't mean it's going to play out step by step, note by note like that. So you have to I find that having that historical analog, but then month after month, quarter after quarter, updating what's actually happening, is kind of that blend it's hard to do, but it's something that we all have to do.
In today's deep dive into the world of finance with Lyn Alden, we uncovered critical insights into the intricate dance between liquidity, economic trends, and market dynamics. Alden expertly navigated through the surprising twists of fiscal policies and global liquidity, shedding light on the resilience of certain assets amid economic softness. From the divergence between liquidity-driven and economy-driven assets to the Treasury's strategic moves countering the Federal Reserve's tightening, we gained valuable perspectives on the forces shaping the financial landscape. Alden's analysis of interest rates and the impact on different segments, from small businesses to the federal government, provided a nuanced understanding of the complexities at play. As we reflect on today's discussion, it's crucial to stay informed and adaptable in the ever-evolving world of finance. Remember to subscribe, like, and share your thoughts in the comments below.